Okay, let's move from that into a talk on currencies, of course, with the next test for the local unit arguably being the release of some Chinese data out today. Matt Simpson, the senior market analyst at ThinkForex, is in our Melbourne studios. Matt, Happy New Year. Welcome back to the show, and kind of a bit of a wild ride, you might well say, the unwind for the local unit following that kind of feel-good support that came into play post-NFP evaporating overnight. What do you make of it?
I'm not too concerned at this stage, because what I'm looking at is if we compare what happened last quarter, it was a steady downtrend. It didn't actually hit 80 cents. Then I think if it was going to, it would have done it. The conditions were there for it to hit 80 cents. It didn't quite manage to do it. And in the space of about a week, it's already gone from the 2014 lows and broke above the December highs. So in that respect, volatility has actually increased at the multi-year lows. So that is a bit of an indication that there's some good buying down above 80 cents. We touched 82.50 yesterday. It was there for about a minute perhaps, and it rolled over. And we're now back within that range of the December low and the December high. But at the same time, because the volatility has increased, and we're above 81 cents now, I do suspect that there's potential to be some buying around the 81 cents level. And I'm just wondering now, we've got quite a lot of data out this week from China, US, and obviously employment on Thursday for Australia. There's enough data to get it back, maybe even up to 83 if the conditions are right. What I think is going to happen, though, is we're going to be looking at some choppy trading. And that's what happened last year. We hit the annual lows. Then we spent a good few weeks in January, I think accelerated, but then rapidly selling off as well. And it's going to make trading conditions a little bit tricky. But I think overall we're going to be drifting higher, certainly this month. As for the Chinese data today, if we do see an increase in the trade balance from China, then I'd expect that to be Aussie negative. But I think it's a bit of an expectation to be higher anyway. So I think there's some upside potential here for Aussie today.
Anything kind of altered your belief in the June mark for some Fed tightening, or where's the market currently positioning itself?
Well, they've been positioning themselves for this mid-year, or look at before dollar index got anywhere near 92. People were buying US dollar, anticipating rates to be increased this year. Now, I've always had a technical suspicion that as we get near to that date, dollar's going to start correcting. Now, of course, NFP data on Friday, there's a little niggly number on that wage growth. So we've even had some people saying they shouldn't be raising rates just on that one number alone. Yes, the headline figure was good, but the headline figure isn't enough. But you'll find that if the dollar's already correcting from these highs on little bits of negative news, then to me that's a little bit of a signal that there might be a few people nervous at these highs holding on to the US dollar. Also keep in mind that although COT's positioning, I think it increased 28% on the net long side for US dollar, but that was before NFP data came out. So I'll be interested to see what happens on next week or this week's release on COT's positioning to see if that's had a big impact or not. So I think what's going to be happening over the first quarter for the US dollar, that we may well start correcting and then start accelerating back along the bullish trend as we approach through the back of the year.
Let's look at Kiwi as well. It's been moving lower as these commodity prices have eased back, but where's now the next test for it likely to come from?
Well, for me, if I just stand back and look at this, what I found interesting back end of last year is that whilst the greenback was accelerating towards 92 cents, the mighty greenback bull was raging, the Kiwi dollar did manage to stay above 76 cents. It had been quite stubborn. And technically it is forming a basing pattern, what you could call an ending diagonal, I suspect. So I think what's going to happen with Kiwi dollar is we've seen a swing low above 76. There's an argument, I think, for it to test up to 80 cents, 80.05 thereabouts. And then I think end of the year we'll be probably trading around the 74 cents level. But if you look at how far the Kiwi dollar can move in a year, it can easily move 1,000, 1,500 pip range. So that gives us quite a wide range this year to play with. But technically I've got maybe a high around 80, possibly 82, a low maybe around 71, and then it will finish around 74. And of course, really what's going to be driving this, it's the Fed and the RB/NZ rate cycles. On one hand, we've got RB/NZ still hinting they're going to be raising rate this year. Then we've got the Fed suggesting they're going to be raising it, but they're being very, very cautious. So if they do start to put delaying signals back into the market again, that's going to bring a more direct, clean, bullish move for the Kiwi dollar. If they both start raising rates, then of course it might be a different game, a lot more choppy trading conditions. But certainly right now, I think we've seen a swing low at 76.
Great to talk, and we will leave it there. We could have talked about a whole lot more, but we'll save that for the next opportunity. Matt, thank you so much.
Have a great week. Bye-bye.
You too.